finance. So we called it a property theory of Islamic finance, especially compared with the way it is thought of usually as historic, based on the historical arrangements that sharing risk is the foundation of Islamic finance, and Islamic finance should be based on sharing risk from probably this idea that the word Catalan also came, that Islamic finance is tasharuki. It is not tasharuki. We will discuss this issue, whether it's really tasharuki or it is not. So this is the sometimes and very often history affects our minds and keeps us sometimes kind of blocked within the box of history. What has happened in Islamic finance is exactly that same thing. The first experience of Islamic finance was the experience of Mead Ghamar. Mead Ghamar was in fact a saving association, saving investment organizations or associations. They were not at all banks, and they were not licensed as banks. They were not treated as banks. They did not have the nature of banks, but we've always thought of them as banks. So that experiment was an experiment of taking funds on mudaraba basis from depositors, and of course use it for investment to make profit, because mudaraba intends to make profit. So we made profit out of them through this investment with the local businessmen. So because we thought of that as a bank, we thought that bank should work only on mudaraba. So that bank should work only on risk sharing. That you take funds on mudaraba, you give funds on mudaraba, or even if you expand it a little beyond mudaraba, then go to musharaka also. So it has to be given on risk sharing. And until today, in fact, there are many writings who would say, oh, the foundation of Islamic finance is risk sharing, which is in fact, to me, kind of strange. I wouldn't claim that I am a faqih, but I do claim that I have a strong fiqh background and strong fiqh study. So it looks to me that very, very strange from the reality of fiqh, which is essentially the minute discussion or rulings or the directives of action for us in general. Now, if we look at another experience, the experience of Tabung Haji. Tabung Haji in Malaysia came around the same time, even 1 year earlier than Mead Ghamar, but in the early 1960s. But Tabung Haji was never at all thought of as a bank, and it was considered as a fund and a management constituted, created by the government to help people go for Hajj. Part of helping them going for Hajj is to accumulate savings and to invest these savings. It was never thought of in Malaysia as a bank, and it was never treated as a bank until today, as a matter of fact. So we did not carry the same idea of putting fund to make it to grow and have it, use it for profit objective. That was not carried on into the bank. When the first Islamic bank established in Malaysia, it took the sample of banks, Islamic banks that were created in the Middle East. not take the form of tabung haji. Banks in the Middle East, when they were established, the first commercial Islamic bank was established in Dubai. It could not function as a bank, as a matter of fact, for the first maybe 2 or 3 years. Continued to, instead of providing financing, they started trading real estate, buying properties, lands, and selling lands, until when the land prices got a crisis in Dubai, and land prices went down very drastically, the bank was on the verge of bankruptcy, or it was in fact in full bankruptcy, unless it was salvaged by the founder of the bank, putting in more funds in it to salvage the bank. But the real process of Islamic banking came with the invention, we call it, of murabaha, with Sami Mahmoud rahimahullah, and deservingly Sami Mahmoud was given the first prize of IDB in Islamic finance. He came with the murabaha idea, as he quoted it from the Shafi'i book Al-Umm, and the murabaha was really the savior of Islamic banking all the way since that time. And it carried then the idea of the So it carried the idea that the murabaha creates convenience for as a base of Islamic bank. Now, when Islamic banks started existing in several countries, of course, it was obvious that we should use or these banks will use the expertise of some of the shuyukh. I hope that some of you may read my paper on the alliance between Islamic capitalist and Sharia scholarship. The Sharia scholars, at the beginning, of course, and continuously, always, all the time, advised Islamic banks that they should use sale contract, and of course they can use also mudaraba and musharaka and so on. Unfortunately, ijara came late, and it didn't really come until the mid-90s. That's about 20 years after the beginning of Islamic banks. Ijara came as another channel for Islamic finance, and it took its place, as a matter of fact, next to sale, and musharaka and mudaraba declined to be the least applied in Islamic finance. Islamic finance, as derived from the Sharia principles, uses 3 channels of financing. These 3 channels are sale channels, lease channels, and sometimes, rarely, the major part is sale, and then next to it is ijara or leasing, and then the least one is musharaka and mudaraba, or sharing in general. But when we look at these 3 channels of finance, we will notice also in them that they really, the common thing between them, the 3 of them, is ownership. You can sell after you buy. And of course, you buy means you become an owner, and then you sell. The same thing, you can give on leasing, you can give on ijara, a property, an asset, of course, after you own it. And if you don't own it, you cannot give it on ijara. And the same thing when you create an enterprise or a project or a business, or when you expand it on the basis of musharaka or mudaraba. Also, we should notice that it is by virtue of owning that you deserve the profit. So when we look at these channels, we notice that owning a property, owning an asset, owning goods, it is what makes you make profit in finance, and without it, you cannot make profit. So, of course, lending is excluded, and obviously lending for increment, for profit, for additions is not acceptable in Sharia, and that is the meaning of that prohibition of interest. Very often we read in some books that the focus point of Islamic finance is the prohibition of interest. And that is, logically to me, is a wrong statement, in fact, because you cannot think of anything as being a main issue, and that thing itself is negative. Not doing a thing is not really, cannot be a focus point or a center point of any action and any project, and of course any profit. By not making loans on interest basis, that doesn't make and doesn't define and does not really introduce what is finance. Unfortunately, you find that in many books, and this is kind of a puzzle to me. On these differences, we mean here return as we know it in finance. You cannot have a return according to these three channels unless you own a property that is able to generate added value in a sense of real addition to the GDP of the country or of the society or whatever you call it. So here we talk about then ownership as basis of Islamic finance, and exactly that, ownership but not risk sharing. Risk sharing that was carried in our mind for a long period, and it is still occupies a big chunk of the minds of many writers, that risk sharing is so important in the Islamic finance. Looks that it has really no importance at all, and it failed to be in the basic fundament of Islamic finance. Now, on the two sides of an Islamic financial institution, on the side of the resource mobilization, acquiring resources, we use resources, we acquire resources either on musharaka or on mudaraba. In both, we create ownership, and by virtue of that ownership, that those who provided funds on musharaka basis or those who provided funds on mudaraba basis, only on the basis of that ownership that they deserve profit, not on the basis of risk sharing. And we will look at the issue of risk and discuss it also, and notice that the risk is like entitlement. Entitlement is the deservance of the earning. You are entitled to that earning because you own, not because you bear risk. And risk is similar to entitlement. Both of them are two facets of ownership. If you own a thing, you are exposed to the risk that this thing is exposed to. And of course, you are entitled to any increment that is that may take place in that asset, in that property that you own. I like to go a little bit beyond the issue of finance. We look at ownership as really a fundamental thing that allows you or entitles you to earn a return. Even when we talk about service, when you provide service that you own, you earn also wage on it. Even with that, you, by providing that, call it factors of production, you earn a return. And then the idea of ownership goes beyond finance to be also in Islamic economics as a fundamental thing. One of the causes of value creating is a property. Of course, the other cause is labor. The labor, but labor also is associated with being provided as a service, is not independent from the idea of being provided into the production as a service, as one of the factors of production. And then owners of factors of production, by virtue of ownership, deserve their returns. So the theory then of ownership does not only apply in finance, it applies also in production, it applies also in distribution, as a matter of fact. The functional distribution of the factors of production, or to the factors of production, is based also on the ownership principle. You own the service that you provide, and you deserve the price of that service. You own a machine that you provide in the production, and you deserve the return of that machine, and so on. It goes on for all factors of production. So ownership is the basis of getting the return or earning. Now, why does the lender not able to deserve in our Islamic economics any return? A lender may sometimes share risk, and there is a suggestion, there is a book by some writers that in it they suggest that the lenders in America should share with the borrowers in house financing the market risk of the item they finance. And even if they share, first of all, let's start with the idea that a lender, of course, bears a risk, bears credit risk. But in addition to bearing a credit risk, if a lender shares the market risk, does that justify his earning? It does not. The principle in our Sharia is that since the lender does not own a property that is able to generate additional value, added value, then the lender it does not deserve any part of added value, because there is no added value that is created to begin with. The lender owns a debt, and the debt does not generate added value. The debt, by its nature, is not able to create increments, and therefore a lender is not in a position to deserve any increment. So the theory goes, in fact, in a consistent way all through. Even if the lender shares the market risk, still the lender should not deserve, because the lender does not own an asset that generates added increment. If you take the idea of risk sharing, perhaps we should allow the lender to be, if the lender shares that risk, we should allow the lender to earn then interest on his loan. If we consider the idea of risk sharing as a basis for Islamic finance, this is one of the flaws also of that risk sharing concept. So why did the proposition of risk sharing fail in Islamic finance? Actually, in reality, Islamic finance went through murabaha, went through ijara, and very little bit of it went through musharaka or ijara. And even when it does, it is the fundament of owning a property that generates increment is what justifies even in mudaraba and in musharaka. But when we look at why the proposition failed, first and most obvious, of course, because risk sharing does not accommodate consumer financing. You cannot finance consumer on risk sharing, although there were some attempts by some writers that we finance building of human capital. I mean, they use the term human capital, although it is human being, but human capital, building human capital can be also shared. So you share the return of that human capital if you finance the construction of that capital through, for instance, education. So you can educate a person and then later share his salary or his return, his income in the market. That was a proposition that was rejected by everybody and tolerated, in fact, because it was called that they applied to it. Actually, all scholars, the idea of akil amwal al-nas bil-batil, taking part of the properties of the earning of somebody without any reason at all, because you can't really share the human abilities. So risk-sharing concept failed in accommodating consumer finance. Risk is not able to generate added value. This is the essential thing. Risk is not a property, is not a thing that can generate added value. And it is really not a thing that can be traded, and not a thing that can be owned. Do you own risk? Do you handle risk as separate from an item or as separate from action or property? It cannot be separated from action or property, and risk alone then cannot be traded and cannot be owned and cannot be considered, cannot generate any added value. This is one of the implications of this, is that we do not accept the sale of risk in insurance. And the idea of selling risk when it is risk alone, of course, this is in insurance, it's clear it becomes risk alone. It cannot be really, for risk, to mitigate risk, we cooperate to mitigate risk rather than we sell risk. Risk sharing does not accommodate the need for definite cash flow. In the finance business, you need definite cash flow. And if you cannot produce a good expectation of a definite cash flow, then it doesn't work really in finance. So and risk sharing does not accommodate that. both in terms of the amount of cash flow and in terms of its due date. Risk sharing is not compatible with the regulations that are common in banking and finance. Preference of risk sharing is not compatible with human nature. Human nature is to avoid risk as much as you can. And risk sharing is even worse than bearing risk, because risk sharing, you are carrying the risk also of another person, which the Quran gave a negative description on it when it says the term shuraka'u mutashakisun, that there is likelihood, whether it is more common or less common is really immaterial. There is likelihood that partners may have differences and may have disputes among themselves. So is it better then to be in a position of exposed to this kind of disputes among partners, or it is better that you own your property, you bear your own risk, and when you sell the property, it becomes owned by the other person, the buyer, and the buyer bears its risk then. So you transfer the risk with the property, and then you have nothing to do with that risk. There is no concept of sharing. So the concept of sharing itself is not really consistent with the human fitra, with the human nature. Risk sharing is more costly than risk aversion, as a matter of fact. This is well-known fact. But no, I want to say one more thing here, which I read in a recent paper by one of the good writers, as a matter of fact, but sometimes everyone has some pitfalls. The writer says that we need regulations by the central banks that would force Islamic banks to make, to provide finance on mudaraba and on musharaka. And of course, when you do that, there is also additional cost for these regulations, and who should bear this additional cost? And why should we need regulations to force them to take more risk? And the natural thing and the fitra is to take less risk. And the fitra also is not to share risk rather than sharing risk. We share risk only when we need to, and out of really kind of necessity. When the size of the firm cannot work without sharing, then we pool resources together and we share risk to create the appropriate size of the firm. But that's another issue really. But again here, the fitra is to avoid risk, not to, rather than to share. Non-predictability of risk sharing may cause monetary and financial disturbances, and that is observed, of course, in the market. So that creates an additional burden on the market. Risk-return relationship is not a causality relationship. It's rather an accompanying relationship. Risk accompanies higher risk, accompanies higher potential return, but it is not the cause of higher potential return. The cause of the return is what you own, and that is that ownership that created the addition or the return. Risk is of multiple layers and multiple levels and multiple kinds. Which one that should be shared, and where and why? Lastly, the failure to distinguish between market risk and ownership risk. In Sharia, continuously, I should say, and across the board, we talk about ownership risk, not really risk sharing. Ownership risk is a sign or a test. We take it sometimes as a test. It's a sign and a test of completion of the ownership. You may own a thing, but if you don't bear its risk, then your ownership is incomplete. Like when you buy an item, but you did not take delivery yet of it, the risk of that item remains with the seller until the seller makes that delivery. And once you take delivery, then we consider that, then only you can deserve any increment that may happen in it. But before that, you do not deserve that increment because your ownership is not even complete. So we consider, we take the risk bearing as a test of completion of ownership and not really as a reason for the creation of the addition. Now, in the property theory of finance, none of price risk, liquidity risk, or credit risk may justify earning. What justifies earning is the ownership and that is associated with the ownership risk, creation or the existence of an increment in an owned property. If an increment happens in an owned property, then you deserve that increment. The owner deserves that increment. This is what both the maqasid and the individual text of Sharia require and ordain. Obviously, ownership risk is there, but also it is not shared. It is not the sharing concept. You see, there is a risk, obviously. You have to bear risk, but you don't have to share risk. And of course, without bearing risk, you cannot, your ownership is not complete, and therefore you cannot create any earning out of that property. Then talking about a new theory of finance, a theory that has its economic and legal foundations derived from this religion, not derived really from any experience outside our religion, from the text and understanding the religion. Entitlement for return is caused by ownership of a property. And those who own property can deserve or do deserve the return of that property. This is a general theory in Islamic finance, Islamic economics and finance. It applies all through, including production, its factors, distribution, development, and creation of added value. The three channels of finance, sale, leasing, and sharing, translate into four axiomatic principles. These are earning by owning. Financial assets are mere representation of what do they represent, and we will see that we apply to them really the rules of what they represent, as if financial assets do not exist at all. We do not recognize them. As a matter of fact, I would say to the extent that we in Islamic economics and finance are blindfolded toward financial assets. We only treat them as mere representation of the real assets. The principle, the realism also, the axiom of realism and the axiom of moral commitment. These are not maqasid al-sharia and not part of the maqasid. These are fundamentals of Islamic finance. These three channels of finance also imply that the characteristics of return in Islamic finance are, there is a necessary condition, a necessary characteristic that without which there will be no return in finance at all, in Islamic finance, that is owning a property, a goods or assets or anything that is able to generate added value. So the sufficient conditions are the property should be able to generate increment, and the property should be able to pass the moral test. This also implies that financial securities are mere representation of their underlying real assets. They are not, financial assets are not assets in themselves. We always look at what do they represent and apply the rules of their underlying assets all the time. And we don't, I mean, this is the famous example is how do we deal with a share? A share in a company is of today is not like a share of the same company of tomorrow, although the number of shares is still the same. But we look at, not at the share, we look at what the share represents, and the share represents is the total assets minus total liabilities, and when we talk about assets, including market capitalization. So we always look at that, at financial assets as mere representation, not really added assets. Islamic finance is then a universal reform of finance. It is finance for the real economy. And of course, when we look at Islamic finance as such, again, there is something missing. I don't know how it is now, how these slides are moving. Really, it looks to me that something is doing something funny. Okay. Now, anyway, upon recognizing this new theory of Islamic finance, property theory of Islamic finance, we need anew to deal with the risk, with development, with the ethical and moralities in finance, and also with the issue of contribution to society. These are four areas that Islamic finance has been under scrutiny and under a lot of discussion by many writers who do not really, and I would always accuse them that they do not fundamentally refer to the Sharia itself. They refer to ideas that are strange from Sharia. So let's deal with these one by one in a quick way. Risk and Islamic finance. The risk issue and risk map in finance have always to undertake deep changes based on the property theory. Risk is a fact of life, and it is a fact of life that life is surrounded with and paved with by risk, a matter which makes risk management a part of the venture of life itself in our whatever we do. So we deal with risk all the time, and we always manage risk all the time in actions or in properties in all our activities. How do we deal with risk in Islamic finance? Risk is not an asset. No risk trading, no risk sale, and no risk exchange insurance contract. That is why the Islamic alternative is to cooperate to mitigate risk rather than to sell risk. No exchange contract in risk. Justice requires earn by owning, and owner bears property risk. So there is a risk that you bear, but you bear property risk as an owner and not in any other capacity. Islamic banks have to bear ownership risk because they must own to earn, in addition to credit risk because they finance. Of course, when we talk about Islamic banks, they provide finance. And if you finance, that means definitely you have to bear a credit risk. But in addition to credit risk, in Islamic finance, we have to bear property risk. Without it, the profit is not justification. Now, credit risk and credit risk sharing do not justify earning in Islamic finance at all, even with the credit risk sharing. Number 4, there is no Sharia or legal or market requirement that Islamic banks or Islamic financial institutions must bear market, that is price and liquidity risks of or economic fluctuation risk. That's not their job, that's not their business. Number 5, wakala in Islamic financial institutions requires minimizing all kinds of risk. And of course, it requires avoiding risks that can be avoided, that are avoidable. Rules of prudence require advanced knowledge of cash inflow, both in size and in maturity, and also requires liquidity matching. Commercial Islamic banks or commercial banks, Islamic and others, have legal and economic responsibility to observe effects on monetary and economic system of their action or lack of action. So in other words, when you finance on mudaraba and you have unpredictable return, you may create a disturbance in the financial and monetary system. So we need to avoid these as much as that is possible. How do we deal with property risk? Definitely, property risk must be borne, must be taken. Without property risk, you don't earn, because property risk is attached all the time to ownership. It's a facet of ownership. It's a characteristic of ownership. If you don't have it, your ownership is not complete, and then you do not deserve any earning. So you must bear the property risk. Yet, it can be minimized and it can be mitigated both ways. So you should minimize it as much as possible, and you should also mitigate it if it is better to mitigate it depending on the risk-bearing level. Market risk, both price and liquidity, can be avoided by focusing on debt-creating, value-generating, exit-definite product. These kind of product, debt-creating, value-generating, and exit-definite, all these are necessary for any financial, any commercial financial institution, and therefore you need to focus on these kind of product rather than on unpredictable product. As for the credit risk, definitely you have to bear credit risk. The issue of development, Islamic finance, there are talks that we should focus on financing investment. Risk sharing finances investment, finances businesses, and don't finance consumers. Where does this come from? Does it come from Sharia? Or it comes from being in a backward country that we need to focus on growth, more on development? Now, if we were in America, probably we should focus on consumer financing better. And probably you may remember that America always criticizes China because of the low focus on consumer goods inside China, and instead the focus on investment and export. And always, Americans always advise the Chinese that you should increase the level of living, the welfare of your own people, and you don't leave them that poor. We have a precedent, in fact, by our Prophet ﷺ, when he asked the question, who among you the property of his heir is more dear to him